Have you reviewed corporate governance issues for Markel? And if so, what did you find?
Absolutely. I believe Dylan can speak to their management team.
Absolutely. So with Markel, you actually have a relatively unique structure in place at upper management level. It's actually a triumvirate structure between the top 3 managers of the company. And in certain cases, you do see conflicts with such a structure. But with Markel, we've actually seen the company benefit since going to this structure. And also, with bringing on newer members to upper level management, supplemented with, or to supplement the existing managers who have a really long extended track record with the company, we think that this kind of frees these upper level managers to focus more on key initiatives, such as leading the One Markel initiative, which we've seen have a great positive effect in terms of cross-selling ability for the company. We think that this structure allows the company to focus on collaboration. We think it positions them well going forward.
Where are the markets for Markel? How many countries? Can you paint the picture for me? And can you tell me, are all the markets equally soft? Are any of them hard where they sell their products and services?
Right. So Markel operates both within the United States and across the globe. The majority of their underwriting is within the United States. However, their London market, which operates principally through Lloyd's, underwrites about 70% of its insurance outside of the United States. So they have both a domestic presence and a significant international presence. As to the hardening of the market, as you can see from the chart here, on most small accounts, there's actually been a decent amount of hardening. The large accounts are just tending to bottom out. But if we look at individual lines, that have really begun to show signs of hardening, the workers' compensation line has really begun to show signs of hardening, and that is really going to benefit Markel as they begin to finish up over-reserving in their workers' comp division, or in their first comp division, which is primarily a niche workers' comp acquisition. So that's really going to benefit them there. Also, the commercial property has begun to show signs of significant hardening. So there's individual lines that are beginning to work its way there. But again, predicting a hard market is very difficult, but we do tend to see a general bottoming out of rates.
Along those lines, tell me a little bit more about the competitive risks that you see for Markel.
Yeah. So with competitive risks, Markel operates in a niche market, as we had just stated earlier. And so while there are some major competitors, they really benefit from the fact that they are part of this niche market, and they have spent a considerable amount of time with their actuaries figuring out this market and understanding this market, because they can insure anything from an athlete's arm to a farm to a Boy Scout camp. So while they do have some competitors, they have really shined being a niche player. And in addition to this, we said that their structure is a little bit different. They have a 22% equity portfolio, which is much larger than their competitors. The nearest one is about 7%. So this also makes it stand apart from their competitors.
Yeah, it's very important to note the difference between a specialty insurer and one of your standard regulated insurers, where the pricing competition is extremely competitive because it's forced to rate increases and rates are forced to be filed with the regulatory bodies, whereas in the excess and surplus market, these are risks that have been turned down 3 times by the standard market, so they're literally unable to be written by your extremely competitive standard insurers. So that allows Markel to really charge a higher rate for the premium of writing this difficult risk. As Liz said, they're really writing unique risks, so then if you look at within the specialty market, they're really separated by their ability to write these unique risks and how each company has different expertise. So your ability to underwrite the risks are really based on your market knowledge of your actuaries, but there's only so much that the actuarial science can show to you. So it's really the time you've been in the market, your knowledge of the individual risk, and that makes it difficult for a lot of these individual specialty insurers to really take business from each other.
With such a large part of your price target tying into the investment portfolio, I was fascinated by your analysis of sort of the the key man and the critical to that success. And to mitigate that, there's a long-term commitment and strong corporate culture that unifies management. Is there anything else like contracts or handcuffs or something that would stop them from launching a hedge fund next month that would put that piece in question?
So going back to that question regarding a hedge fund, to really evaluate Tom Gaynor's commitment to the firm, you have to look at his track record with the firm. So he's been with the firm for 22 years and was actually brought in a relatively unique situation. 22 years ago, he was the president and founder of Tom Gaynor Asset Management. And the firm basically went out and bought Tom Gaynor Asset Management and brought him into the firm. And he's been there for 22 years, and since has not only taken over the entire equity portfolio, he's taken over the entire investment portfolio. He's set in place a team of professionals around him that have really built and developed a system towards value investing and all the philosophies that he espouses to really continue the process that he's developed going forward. Furthermore, he's established this additional arm called Markel Ventures, which is effectively a private equity principal investing arm, making investments in small companies and then taking a share of the EBITDA from each of those individual companies. So while we are not actually aware of any golden handcuffs that are in place, we don't think that he's going to jump ship for a hedge fund due purely to the fact that we believe that he's a company man. But we also don't think he's going to jump ship for a hedge fund because we don't think that the legal structure of a hedge fund is truly valuable to the investment strategy that Markel espouses. And to look at their total strategy, we like to point to a company like Berkshire Hathaway, who employs a very similar investment rationale. And Warren Buffett has not structured his company like a hedge fund because we think that hedge funds are not entirely conducive towards performing within this investment strategy, given that they're making investments over the course of 3 to 5 years. And to secure that kind of lockup period in a hedge fund, you'd have to be investing in some kind of special situations, bankruptcy situations, or other things like that. And they really wouldn't give that to a long-only value investor. And so we think that Tom Gaynor is in it for the long haul because he's been around, he has responsibility, and we think he's a company man.
Could you speak to the other parts of the investment portfolio? You focused on the equity and 22%. Could you talk about the rest of the portfolio?
Speak to the allocation of the investment portfolio?
Yeah, the allocation and the components and the risks in the portfolio.
Absolutely. Liz, would you like to address the fixed income allocation of that portfolio?
Oh, yeah. We took a look at Markel's fixed income portfolio, as this is where most of insurance companies put a lot of their money, just due to the risk. However, as you would expect, they're in a lot of municipal bonds, they're in a lot of treasuries, a lot of AAA, AA rated companies. Nothing too risky, nothing too interesting either, I would have to say. But it's stable, it makes sense. And then other than that, we did say that they have 22% in their equity portfolio, which is where they're generating the majority of their alpha, which I think Dylan can talk more about.
Yeah, and Markel team's strategy for, especially with comparing the fixed income to equity, when their combined ratio, every dollar of combined ratio, the difference between their current combined ratio and 100, that gets funneled directly into the equity portfolio, which is where the risk taking is occurring. They're really just matching durations and being extremely conservative with the fixed income side, and really just matching every dollar of combined ratio with that. And with the equity side as well, it's almost uniformly large companies with mostly dividend paying, very long-term investments. But again, they're free to do what they wish with the equity portfolio set aside with each dollar of combined ratio.
I find a lot of interest in this comment about the company adding alpha. To me, a company's goal is typically to be profitable. And it's our job as analysts and portfolio managers to add the alpha. Can you tell us a little bit about this concept? Is this something that the company is stressing, perhaps because of their good investment returns in the investment portfolio?
Sure. So we have less than a minute, so I'll try and be quick. But a combined ratio of over 100% doesn't necessarily mean they're not profitable, because they generate returns both on their fixed income as well as their equity investments. And what the company what any company in the insurance industry is trying to do is grow book value, because that's the primary way that they're valued by the market. And so the best way for them to do that in a soft market is to expand or to benefit from equity appreciation. And because Markel has generally had a larger portion of their investment portfolio in equities, they've been able to grow book value at a faster rate, which for you as an investor is how the market's valuing this company. So you want to see that book value growth, which has been provided by the equity portfolio. So when you're looking for growth in their equity, That's really in a soft market where they're having troubles with the underwriting, that's really where you're going to find that.